So, hello and good afternoon. I welcome you to today's Trading Spotlight webinar here together with Admirals. It's Friday, it's the 26th of June, and we have a very fascinating topic, I promise, today here. And it's about the order book. It's not just that some technicals like looking at bids, offers, and give you some insights and how to get the spread out of this and so on and so forth. But in fact, I want to give you a quite deep introduction into the mechanics and dynamics of the order book, of the order flow. We want to keep it theoretically, certainly, so we don't will have a tape running or something like that. But what we want to do is, or what I try to achieve within this video is to give you some thoughts on not just how the order book works, but also how you can read the order flow, in fact, at one or the other point. And then you will also get a deeper understanding on how to, in fact, see how bigger players, dynamic players, in fact, we could call them, try to manipulate the order book in one or the other way, and how to spot this, and not just how to spot this, but also how to avoid it in the future, and thus get a more, let's say, mental stability, a higher mental stability, greater mental stability in your trading here, thanks to that, and also how to use this to your advantage in the future then. And yeah, that being said, if you watch this now on YouTube, then please leave a thumb up here. Please subscribe to the YouTube channel. Please set a reminder to not miss any of all the videos which are produced here for you, in fact, to make progress in your trading. It's not just me, but it's also Marcus, it's also Paul. What else? Please leave a comment in the section below if you have any questions, if you have any suggestions, any wishes, any topics you want to see here being uploaded and being discussed in the future. Please feel free to let us know. And let's get started. So let's get started. Let me share my screen here. So this is the first slide. Before we go in depth again here through the agenda for today, I'd like to give you some thoughts here on the current rebranding taking place at Admirals. You probably have seen that Admiral Markets is now Admirals, in fact. And the question is, why is that the case? So if it's not the first webinar, so that's kind of repetition, let's say, here. It's about the offering from Admirals, from a started as a Forex and CFD broker, made its way up to the probably most well-known, recognized, and well-established names within this industry, with the probably most competitive offering. At least here in Germany, we refer to Admirals as the DAX expert, for example, with the very most probably attractive offering when it comes to CFD trading around the DAX. And over the years, then there was some certain developments taking place, and it became clear that there is so much more when it comes to financial services, in fact. And now Admirals is offering, for example, a credit card. You can find all the details around this on the website, admirals.com. And not just that, but also there's some further plans in terms of the crypto environment, how to profit from it, how to make it more accessible, in fact, for traders around the globe, but also investors. There's also this multi-asset brokerage offering when it comes here to physical stock trading, for example. You can trade via MT5 and the invest solution from Admirals here within the space. So make long thing short, Admirals is now broader, let's say, and tries to be more recognized as a financial service provider, fully regulated. And next slide here, it's also taking place in the social media hemisphere. So you probably have heard about Admirals have already subscribed probably to the YouTube channel. If not, again, subscribe to the YouTube channel. It's one of the biggest, in fact, here in Germany. Admirals Germany has the biggest YouTube channel, and not just there, but also on Twitter. Follow Admirals there. Also on Instagram, you can see it here at Admirals Global, for example. So long thing short, well established and to be found everywhere. If you want further information, check out admirals.com. And now we want to have a look at today's agenda here. So around the order book, I already introduced that at the beginning. So what we want to give, first of all, is an introduction to the order book. and then present the order book, in fact, and how to use it. What you will know after this is why, for example, spreads widen. So some of you might have seen news releases like the non-farm payrolls. You have seen probably the Fed, you have seen the ECB rate decisions, and then certain currency pairs, especially Euro USD, dollar JPY, gold also. The same is true for the S&P, Dow Jones, NASDAQ, the DAX, whatever. You see the spreads widen there. And this is sometimes annoying, let's say, but it's in fact the most natural thing in the world, because it has something to do with something we call uncertainty. And the higher the bigger, the higher the uncertainty in the market, the wider the spreads will become, because the less likely it is that the market participants will bid for, let's say, a stock or currency, whatever, respectively, will offer it, which means that there will be a natural widenness, or however to say that. So it's natural that the spread widens in this environment, in fact. But then you can also use this, for example, and this has been a question over the years, over and over again. If people ask me, hey, if I trade news or around news, let's say, I don't hold the position over the news, but then I want to position myself after the news is released. When do I know that the market is, let's call it, back to normal? Here also the order book, respectively the spread, once you understand what's happening there, gives us a clear answer to that. Because if you, for example, look at Euro USD and have a spread of something like 0.3, 0.4, so in the raw spread environment, 0.2 probably also, then if this is the natural spread, let's say, the spread you usually see, well, then if the spread widens to, let's say, not just point, but 2.5 or 3 pips, or sometimes 10 pips, depends on the news and the volatility which is causing the event, then you wait till the spread narrows again. And then it's a clear sign that liquidity comes back into the market. You look then at the chart and you work with the news which just was released to establish your position. So also here, it's very important to understand, even if you do not use the order book in your trading at all, even though sometimes it could make sense, in fact, to read the order flow, to check the tape, in fact. But if you don't use it here in this context, it has a direct correspondence, let's say, or direct correlation in this context to the spread, and thus to the overall width of the spread, which you could use as a trade decision maker, let's say. And then after that, I'll introduce the players in the market, and I'll give you some deeper thoughts on what you can make out of this knowledge here, and what conclusions you can draw out of this, and especially here look at the psychological perspective. So now let's start with an introduction here to the order book. So first of all, the order book is an electronic list, if you want, of buy and sell orders for a security or every other instrument organized by price level. You have probably seen that. You can also check the price ladder, for example. In the Supreme add-on, you can download for free in the MT4, MT5. So if you download on admirals.com, a demo platform, to check out the offering from Admirals here, you have also the opportunity to use this Supreme add-on package here, and there you have the so-called mini terminal. Sometimes you have seen that probably this is this green, respectively red ladder on the right. You can display them, and so this is meant by price level, respectively price ladder, and then could be used to trade directly out of this price ladder. But here we want to first of all look at the order book and at it in itself. And so what order books do is, in fact, or what they're used for is they are used by almost every exchange for various assets like stocks, bonds, currencies, and even cryptocurrencies. What's certainly interesting is to note here, when we talk about currencies, we have to be a little careful because most of the time currencies, FX, are traded decentralized, respectively OTC, we call this, so over the counter. So there's no stock exchange which really calculates the volume, but who counts how much volume was done on a certain price level, for example. So for example, I'm very skeptical when it comes to market profile in terms of FX markets, because most of the time what you see see there is not real volume being done on a certain price level, but it's more like the ticks which were done on this level. Because, and this is very easy, if a bank is trading with another bank, let's say 1 billion euro USD or something like that, this is a number which appears in the book of the banks, in the book of the buyer, respectively the seller, but we as retail traders do not have access to this. So what we usually see, if we have kind of a volume being displayed here in our platform, is the volume which was done then at the broker by the retail traders. So this is not the real volume, but it's just an indication, we can call this probably. Even though when we look at a broker like Admirals, for example, a big broker with many clients around the globe, well, then certainly the indication is way better than if you look at a small broker somewhere, yeah, probably not regulated, and this context then, and look at these numbers when it comes to volume. So here in this context, and there also the order book comes into play, because it shows you how much volume, how much buyers and sellers are on a certain level. You can certainly also display here in the FX market then this volume. But again, be aware of the fact that it's most of the time a decentralized market, and thus you don't get the full in-depth view here on this volume being done. So and now coming back to the order book, so this list we are talking about here, this helps to improve, in fact, market transparency, as it provides information not just about on our price, but also availability, depth of trade, and who initiates, in fact, transactions here. And there are, in fact, 3 parts to an order book. So it's the buy orders, it's sell orders, and it's the order history. And in this context here, oh, I'm sorry, that was the last bullet point. So to make things easier now, I've took a snapshot here of an order book. In fact, I Googled just order book, so it's a snapshot. I have not put in any source here. In fact, this is probably not very professional, but the order book looks the same. I don't even know whether on which asset I took the snapshot here. But most likely it's the S&P 500, probably the E-mini S&P, which is here in the future then, which is traded at the Globex CME. But it doesn't really matter, because the functionality, respectively, how it works, the order book, how it works, is usually, it's not just usually, but it's the same. If it's the DAX, if it's the S&P, and wherever you take the snapshot, it's always the same idea behind this, the same logic. And so in the order book, as you can see here, you can find the respective order situation for a specific trading instrument in this context. So, which means then we have here the bids, which show at which market, at which price market participants are willing to buy. So there's a price missing in this context. So this is here, the left part, it's the bid. And then you have also the ask. Probably you have heard about the offer also, probably in this context here. We have the ask, we have the offer. In Germany, we call this, for example, Briefseite. So it's brief is the German word for letter. It's like, and that's very interesting. So probably you have read about my history in the markets and how I got started when it came to trading. So it was more the really professional way. It wasn't that I downloaded a trading platform from somewhere at any broker and then started trading, but it was more like that I wanted to really learn trading. Given the fact that my initial plan after I worked in a bank and then decided to study mathematics, that I wanted to make my way to Wall Street, in fact. So that was early 20s. That was a funny time back then. And it was that I wanted to find a job then where I could really learn something about how to trade. And here in Berlin, we have a big stockbroker, in fact, who was looking for students, respectively working students and trading assistants back then. And this was my first connection really with the markets, and in fact here with order books, in fact. And thus I got an introduction here by a very experienced trader. And what she told me was, in fact, it was a woman, which is noteworthy, because usually in trading, you're not that often, you're not getting that often in contact with women. Usually this is like a hemisphere, which is usually dominated by male. But the thing is that there were plenty of women which were very, very successful traders. So that made a big impact on me. So I have always to smile a little when I listen to colleagues talking about not that many women being around in the world of trading. So my first impression of the world of trading was that women are in fact very, very good and very smart traders, in fact. And so she was the one who taught me on how this order book works. And now coming back to the Briefseite, the German word for this, so the letter, in fact. And what she was talking here, by the way, this is this column here. She said, well, you can imagine that the following. So we are talking, okay, let's put it differently. So bid here, the bids, the ones we're willing to buy. In Germany, we call this Geldseite. Geld is the German word for money. Okay, so and you can understand it that way. The guys who have the money, and these are the guys who want to buy. Thus, we call this here the Geldseite. So the bid and the offer. This is the one who is the Briefseite, who is the one with the letter, with the in this case, the share, for example, he wants to sell, and he's like doing that way here. I have the letter. You can buy it from me, and that way I understood how this works. In fact, so very easy way. In fact, these are the ones who have the money, who want to buy, and these are the ones who have the letter, or respectively who have the piece you want to buy, and these are the guys who want to sell. And let me just, by the way, check here. You cannot hear me. Okay, that's interesting. If that's the case, I'd say it's most likely because it's a local issue, because I can see here we have nearly 50 participants only here within this event. And if there was an issue, I think here the chat box would go crazy. So most likely, even though that doesn't make sense, because if you don't hear me, you can't hear what I'm saying here. Probably someone can write him a message and tell him, because then else it doesn't make sense, right? So he can't hear us, or respectively me. Okay. So coming back to here to the price ladder. In fact, so it's called the price ladder. In the middle, this is the ladder. You can go up, respectively go down, depending on whether there is demand in the market pushing prices higher, respectively supply, which is pushing prices lower. And so what you have here in turquoise, you can see it here. This is the price at which the last trade was executed, and which you can see, for example, on a website or on the board at a stock exchange, for example. So if you switch on the television here in this context, you can see that this one here is the last price, and this is the price which is then shown on a website. You check out Market Watch, for example, let's say. Respectively, if you check out the financial media, you see a print there. So this is the last price where a trade took place and where there was an exchange between buyers and sellers. And so now the interesting thing is here that the difference between the bid and the ask price is called the spread. Okay, so in this context here, we have now 477 buyers at 2,167.75, and we have 290 sellers at 2,168. So which means the quote you can see at the broker in this context here is 2,167.75 to 2,168. So the spread is 0.25. So this is in fact the spread. So now you might probably wonder, okay, and you can already start to think in depth about this now, more and more detail. Just imagine you want to buy, let's say, 500 pieces. So now you cross the spread. This is something we will introduce in a little while. But you say, okay, I'm buying here. I want to buy. It doesn't matter the price I pay, because I want to be long, because I think that the asset XYZ will rise in price. So now you buy 500 pieces, but there's only 290. This is the moment when slippage occurs. So once there is not enough liquidity available here at the price for the size you want to trade, well, then you are slipped by, in this kind, 0.25 here in this case, because then in combination here, your order 500 is filled 290 at 68, and then another 210 in this context at 68.25. roughly speaking. So the same is true when you sell. So this is how you can understand where slippage occurs and where positive, respectively negative slippage can come from, in fact. So it's market given, in fact. So it's not that there's someone standing trying to rip you off your hard-earned euros, dollars, or whatever currency we're talking about, but it's more, it's like the liquidity situation you can find in the market given by the order book, in fact. So what we, oh, I'm sorry, this is a little unfortunate. Let me just see. Okay, let's do it that way. So now, now the question comes into play: how or why does, in fact, a spread widen? How can this happen? So here you can see that the width of the spread is, in fact, variable depending on the price at which market participants are willing to buy or sell. So usually it's not a fixed number, but usually it's a number which varies, in fact. And this means that, for example, if uncertainty hits the market here, for example, due to news, as I already said at the beginning of this webinar, like non-farm payrolls release, like Euro Central Bank rate decision, like the Fed rate decision, you have a widening of the spread here, which is natural because here in this context, market participants get uncertain, in fact. So, and here then you can see that the driving force is, in fact, the so-called market orders, not the limit orders, which means, in other words, market orders bring movement into the market. So in one or the other direction, if it's going higher or if it's going lower. So let's put it that way. If, as I already explained here, you have 500 pieces to buy, you cross the spread, you say, whatever price is right now here being offered in this case, I want to pay this price. I want to cross the spread. I don't want to place my 500 pieces here at 2,167.75, but I'm willing to pay the spread here and buy at 2,168. This is bringing movement here, but because the next print now is not 168, but it's 168.25, because here 500 pieces, as I already pointed out, can't be fulfilled because here you only have 290, 500. So which means you push the price higher. So it's your market order which moves the market. In fact, here the limit orders, we refer to this here, the limits on the up, respectively on the downside, they are fixed, let's put it that way. Okay, so they don't move, or it depends on where you're willing to buy, respectively where you're willing to sell, depending on them, how much demand, respectively supply, comes into the market. And so what we have now here is the moment uncertainty hits. So which means the bid step lower, respectively, the ask step higher, because the people say, I'm not willing to sell anymore at, let's go back here to this. I'm not willing to sell anymore at 2,168 because I don't really know whether this price is still fair, given the incoming news, which I don't know yet. So I don't know whether the news will be positive or negative. So this uncertainty here results in sellers stepping up here, let's say to 2,170, while the buyers step down and say, well, I don't know what this news will be, so I take my bid out of the market until certainty resumes, or I know what I'm facing here and how the news is then published, and thus I take down here my bids in this case down to, let's say, 2,166, which means here earlier we had a spread of 0.25, and now uncertainty hits because the news release is coming into the market, and now we have a spread of 4 points, 2,166 to 2,170. So that uncertainty obviously widens the spread. And the explanation for this is the dynamics of the order book. So which means like buyers stepping down, sellers are stepping up because they say, well, I don't know how this news will be interpreted, so I'm out here. And thus we call it liquidity is drying up. So liquidity dries out. And thus you can also see here, for example, and another idea. We had an earlier webinar on ethics and basics in Forex trading, in fact. And then here in this context, we, for example, introduced the concept of why spreads in so-called minor currency pairs are naturally wider than, for example, in major currency pairs. So that being said, why is the spread, let's say, in GBP USD, respectively Australian dollar against USD, why are these two major currency pairs are tighter when it comes to the spread? But if you look at GBP against Australian dollar, you have a wider spread. Well, because if you want to make things easy here, the spread in GBP Australian dollar is in fact the sum out of GBP USD and Australian dollar USD. And then you have also the component uncertainty if you have enough liquidity available, which naturally widens the spread in GBP Australian dollar even further. So that being said, results in a naturally wider spread in such a minor currency pair. So, but let's now have a look here at the players in the market. And here now, let's have a look at the psychological aspects to some extent, respectively, the games which are played, so which we will start with here in this context. If it's, oh, I'm sorry, Danny asks, is this also the price one can see in the tick chart? So you're referring here to the chart. You can, this is like the 1 minute chart, but even one, how can we say that? Step more down. So it's even a lower time frame, like a 30-second chart, for example, or a 15-second chart, for example. No, in fact, that what you have here is the core of the candle, we can call this, in fact. So it's like it's really like yeah, to some extent, what we don't have here is in fact the times and sales. So this is probably something which would also be of interest here to look at. I haven't prepared this because the main focus or main target here of this presentation is in fact just give a rough overview of the fundamentals of the order book, and then take it one step further. What we can do, which conclusion can we draw out of this from psychological perspective? But usually this is the tick chart is in fact depending, or the tick chart here in this context gives you every tick which is printed, and to some extent probably you could say it's also the times and sales, even though it has no real, yeah, probably, well, we can call it that way. Even though I wouldn't necessarily look at here the times and sales, so at a line, but I really like to see the prints at on which the price was done, and how much volume was done on the price. So if you have a, let's say, horizontal line in this context, that shows that the time hasn't the price hasn't changed, in fact, but it doesn't give you any idea on how much volume was done there. So you can certainly look at volume bars, which are then displayed below the chart. But in fact, that's, at least for me, it doesn't make really sense. So if I want to see the order flow, analyze the order flow, what to draw, which conclusions drawing out of this, I certainly look at the tape, respectively at the times and sales instead of a tick chart, in fact. So let's have a look at the two groups now here, the two players in the market. So there's in fact two groups. So this is the, we can call them the dynamic players and the passive players. So I can already make long thing short, and there's a spoiler now. So we are the passive players. So we are not the dynamic ones. The dynamic players are those who are, well, we can call them the big guys. And these guys can manipulate the market, at least short term. So this is what I'm referring to here. And here, in this context, I will explain this in a few seconds with a picture. But I had to sometimes smile a little when I listened, especially to the news, respectively, everything which was somehow high frequency trading related, because the techniques being used there, like spoofing or stuffing the order book in this context. That has been a technique ever since. So that this game has been played already back in the days when there were still floor traders. So it hasn't really changed the idea behind this. In fact, what I want to introduce to you now. So in this context here, like the bids are packed, respectively, the offers are empty, suggesting that there are only buyers and the market will go up. Respectively, the offers are packed and the bids are empty, suggestion that there are only sellers and the market will go down. So this is something we usually refer to as spoofing. So to explain this even a little better, so this is an illustration of that. So we have the bids here and we have the offers there. And as you can see, there's obviously lots of buyers, while there's not that many sellers here in this context. And now this is something which you can from time to time really spot here in the marketplace, and stocks, for example, but also in the future market, in the FDAX, in the S&P, and so on and so forth. And there's these big orders here, and they are suggesting there's a big buyer. There's such a big buyer here in this context, and thus the market can only rise. The only thing is, when you, and this is then the moment once you have to check the chart, or respectively not the chart, but the times and sales in this context. If you see that here, if such a occurrence appears in the order book, well, usually what happens shortly after is that the market drops, especially here if these buyers disappear. This is something we can in fact use. Sometimes really, in fact, this is a sign that the market has a chance to rise. And thus what we try to achieve here in this context is, if we spot such a occurrence in the order book, and if we have this in combination, let's say, with a technical relevant level where was lots of volume being done, or which was identified already in the days before, something like that. And you have here then in this area such a big buyer who's willing to buy against this support, which you can also spot from a technical perspective, then it could make sense to give it a try, to step in front of this big buyer, try to get a fill and have a stop slightly below this big buyer. So this is especially true for scalpers, for example. So scalpers are usually working that way, trying to get into the market here with a very tight risk, something like 5 cents or 10 cents max, and then see a big bounce against this technical level. But, and this is the thing, the stop is slightly below that level because it could be that it's just a so-called spoof. It should suggest that we have a chance to bounce against that level, but instead here this big buyer drops, and thus the bid drops, and thus we push lower from there, which is very interesting to note, in fact, because you can also look at it from another perspective. What you will notice in this moment, once you have such an occurrence here, and then there's no such bounce taking place against this level, this is something which is usually a sign. You have always to wonder, who is selling here? So wow, because there's just buyers, but now there's obviously there's in this case it's like demand which is filled at a price without seeing a bounce from here. And in this context, obviously the guys who suggest here that the market will bounce from here because there are lots of buyers that have enough buying power. They are the big guys. These are the guys who have enough buying power to push a market higher in this context, move a market, we can say. If these guys here suggest that there's just buyers there, but the market does not move against that level, and here the supply comes into the market and is high enough to keep the market at a low level, that shows that these big guys obviously just try to how to say, not manipulate, but like keep the market in the dark of their main intention, let's say, because these guys suggest, well, we want to bounce against that level, but instead they are now stepping here and selling against all these guys like me, for example, as I said, saying, hey, I step in front of these big buyers here because I want to get a fill, because I see a potential bounce against that level. And then they are selling. And there are probably also some other guys thinking the same way as I do, saying, okay, I wanna buy, I buy in front of these guys, and probably also cross the spread in this context. So I'm buying here, let's say that at the next level, let's say it's 45 or something like that. I'm buying at 45, I'm buying at 45, and the market does not move, which is a clear sign that there's someone obviously willing to keep the market at a lower level, at a lower price, respectively, fulfill my demand, which means there's also a seller, a quite big seller, obviously. And this is a clear sign that it's just a suggestion that the market will bounce from here, but instead, these guys suggesting that the market will bounce are, in fact, the sellers keeping the market low. And this is something where you can then see how important it is to also have a clear picture on the times and sales in this context, and see where this volume is being done, and if there's lots of volume done on this level, in fact, because it suggests then in this context that there's probably more selling pressure than the picture you get here out of the order book suggests in this case. And this is something you won't see in a tick chart then, or in a line chart, let's say. So this is something you can only see by the prints which are being done. The same is true on the other side. If you have the same picture happening here with big buyers, big sellers stepping up and saying, well, this is a level where we want to sell, and we keep on selling, and the market does not move. So it doesn't really bounce against that level. And it's a clear sign which is sent in from the market. It's probably a sign that they're playing the same game as they did before, but only from the other side. So in fact, they suggest they're willing to sell big and push the market heavily, bring it under pressure, but instead they are keeping the market quite stable. And here in this context, buy from these, respectively, buy from these who are stepping in front of the big sellers here and saying, okay, I'm crossing the spread again, I'm hitting the bids. And then you see they hit the bids, but the bids hold in this case. So they don't drop. And this is a clear sign that probably the guys who suggest that the market will break lower from here are in fact the ones who are willing to buy here in this area. And once in this case they have their demand fulfilled, they lift the offer and the market shoots higher in this context. So this is in fact something you can see that theoretically, I think this is easy to understand, but it really needs, you need to be the guy to play this game, or to trade that way. This is something I mentioned earlier, not just in this webinar, but also in earlier webinars we did together. You really have to know yourself well. You have to know your, in this case, cognitive strengths. So in my case, for example, I really have to be in my zone to be capable of spotting these occurrences here in the chart, really be focused, have a very good preparation of my day, know the levels I want to watch and what to watch for, in fact, and then take it from there. Once this routine is interrupted, I have really trouble to stay focused enough to trade this profitably, in fact. And it's in fact completely fine. If you know that, that's perfectly okay. You don't need to trade that way. It's just important to recognize this also for your trading in general. Once something works, do more of that and do less of what doesn't. If this is not what works for you, well, fair enough, then you should definitely look for another style of trading in this context. It was very important to note, because what we now did, and as you can already see, this will move quite quickly. So we are not talking here about something like this is taking minutes, but you have to really see it. You have to really see it, and you have to feel it, and then push the button. And there's no second guessing or something like that, which means that scalping especially, so something which many beginners are looking for in the trading, saying, hey, I want to be a scalp trader. I really love this speed of the tape in this context. I mean, I can fully understand that, because that was one of the main reasons, these flashing lights everywhere, that was one of the main reasons why I got attracted by the markets. But then you realize this is probably not your game. This is not what your cognitive strengths are. If you're a more let's call it analytical guy, the guy who wants to start to think about something first and then take a decision second, and needs some time to evaluate the situation, then this is probably too fast, even though it's still important to note that, because you can also, if you have a bigger picture in mind, for example, you can also use this information here to see once there is a certain level being held, for example. So you can also see over time, this is then also something you can spot in the chart. If you have an intraday consolidation taking place, for example, for several hours sometimes, and the market is not dropping that level, and you watch the tape and you can see, well, it's not dropping. And then you see this, for example, here, that some market participants are spoofing in this context and suggesting that we are about to break lower, but the market doesn't break lower. It holds the bid. It holds the bid for minutes, sometimes hours, and there's a tight consolidation forming. If you can spot this, it's not all the time, but sometimes it's a sign that we are about to, rather sooner or later, break higher for whatever reason, whatever the trigger might be. But some guys know more than we do, and they use this information, but they have to build a position. And this is something then where you can see the money. You can see the order book, and you can see the times and sales, and they can tell you everything they want, let's say on CNBC or something like that. They tell you, well, the stock will break down or the currency will break lower or whatever. And then you watch this chart, you watch the tape in this context, you watch the times and sales, and you just wonder, if it's about to break lower, okay, but there's lots of volume, let's say, being done at, let's say, 23 in stock XYZ or something like that. So, well, if everyone is selling here, who's buying? Probably the same guy who just said you should sell. Just a thought in this context. And that's why here in this context now, the order book also becomes very important from a psychological perspective. So as I already pointed out, we are the passive players in this context. And we are betting, in fact, once we enter the market, that someone else will buy, respectively sell, after we bought, respectively we sold. So we are not playing these games. We don't try to accumulate a position and try to bring people to sell or to buy or something like that. But we are, in fact, the ones who are crossing the spreads with our orders. And we are buying here, respectively selling and betting that the market will rise or fall. But it's not us taking the decision whether the market will rise or fall, because it needs someone else and his expectation, that's the word, expectation that the stock, currency, index, whatever, commodity will rise, respectively will fall here after we bought, respectively sold. And so as I said, we are the players, we are the players who pay the spread. So based on the suggestion of the dynamic players, that the market will rise and drop. And that being said, brings us to the following conclusion. Let's say we have a move here from 100 to 101. And this is nothing else, in fact, than the conviction that the market will continue to move higher after I bought, if I bought in this context. And that means that we need an ongoing imbalance, in fact, here of conviction. So we are really talking about expectations, convictions of other market participants here, that the market will continue to rise, respectively fall. But if we are only trading, in fact, the conviction, respectively the expectation of other market participants, which we obviously can influence. I mean, no one would ever say that I can influence the conviction of any of the participants within this webinar. So no one would ever say that and say, well, I know that everyone here is right now, let's say, bullish Nike. Yes, let's say Nike, because they had a great earnings report yesterday. And so, well, that's the reason why the stock will rise. That's not going to work. It's just not going to work that way, right? And so we can't really influence this conviction, the expectation of every market participants in the market. And that's one of the reasons where we come here to a very interesting question. Why on earth should I then care about a losing trade? Because it's just not in our control anymore. We give up our control once we enter the market. And then in that moment, once we entered the market, we bought, we sold, whatever asset, doesn't matter. Bitcoin, DAX, Dow, S&P, Nike in this context, a stock, Euro USD, whatever. we are 100% dependent then on the conviction of other market participants and can only influence, in fact, how much we lose if we lose and how much we make, how much we gain once we win, once we're on the right side of the trade. And that being said here, brings us to a conclusion of this webinar, in fact. So the order book, once you understand it in depth, it's just not about technicals, but it's also a good way, a great way to understand that here in this context, what we do is, in fact, we trade convictions, expectations of other market participants. And this is something we can't influence. So what we can, and then we could go a step further. We could now say, well, let me introduce you another important concept in trading. It's about the so-called expected value. It's a key component of risk money management. You can see there why risk money management is so important, because if you understand risk and money management, then you're not just talking about technicals. Like the expected value is here in this case the difference between the average average winning trade multiplied with the average, the average hit rate, but the hit rate. So average winning trade multiplied with the hit rate, and then you subtract the average losing trade multiplied with the loss rate in your trading. So this is what you get, what will get you the expected value. So this is a mathematical formula. You look at this and say, okay, I understand that. And if it's a greater zero, then it's a profitable decision, and then I should take the trade. But it's more than that, because now you understand that if you trade convictions and expectations of other market participants, given what you know now about the order book, is that you can influence whether your trade is a winner or a loser. So you have no control of the hit rate, respectively of the loss rate in your trading. But what you have is, in fact, a tool here to manage your risk in this case, or respectively, not just the risk, how much you lose, but also how much you make. So average gain, respectively, average loss in your trading. And these are the two components you can influence in your trading. You can control, because it depends on how much room you give a market to move against you, respectively, how long you take a position once it moves for you, and once you decide to take profits, hopefully in a way that your average winning trade is way greater than your average losing trade. And that brings us to today's summary. So again, an order book is an electronic list of buy and sell orders for a security or other instrument organized by price level. So the price ladder in the middle. And order books are used by almost every exchange for various assets like stocks, bonds, currencies. Again, there's something you have to consider when you look at currency pairs, especially OTC market, and even cryptocurrencies. You can also have here the stock exchange like BTFX, I think it's the name. So there's many of these out there. It's also not really centralized, but still there's also some arbitrage then taking place. You can also take a look at it from this perspective. And if Bitcoin is trading at one stock exchange, let's say for $34,000 and at the other at 36, well, obviously there is a risk-free trade in this context, buying it at 34, selling it at 36. And this will happen once their two prices meet again in the middle. But still, the idea is here that you look at a centralized market, the reference price, in fact, the reference market, and then here use the price and the volume being done based on what you find in the order book. And the list here, the order book, this electronic list here helps to improve market transparency. And you have here in this context, obviously, information on price, availability, depth of trade, liquidity, and also who initiates transactions. And as I pointed out, so the two players in the market are the dynamic players and the passive players, with the dynamic players being the guys who can manipulate the market in one or the other direction, make a suggestion that the market will rise, make a suggestion that the market will fall, while we as the passive players cross the spread and say, I bet that this and this will happen. But we can't influence it because we depend on whether there's now conviction among market participants that our thesis plays out to be right. And so the order book, what it does is it illustrates that we are only trading the conviction, expectation of other market participants, helping to understand that it just doesn't make sense to care about the losing trade, to care about whether the market will rise or fall. It will do one or the other, but we can influence this. Never, ever. It's not possible to influence, to control the conviction, expectation of every market participant out there. And so that being said, we give up our control once we enter the market, and then are 100% dependent here on the conviction of other market participants, which means that we can only influence how much we lose, respectively, how much we make once we find ourselves in a position. So if you like what you just witnessed, again, please leave a thumb up here in the recording on the YouTube stream. Again, I also recommend you to set not just subscribe to the YouTube channel, but also set a reminder for the next webinar. And why? Well, because the next one, I'm sorry, it's not Monday. I'm sorry, it's Wednesday. Let me just change this here. Wednesday. Okay, that's better. So Wednesday, it's then the 30th of June here. I'll be here again, then with a hot topic, in fact, and the question I want to give an answer to here, why you should start to think about investing in renewable energy. And the answers here we want to answer, questions we want to answer is why green investments should be part of your portfolio, at least in my personal opinion, but I think we probably agree on one or the other way that this is some future related, let's say. And we also will look at the aspect that the diversified portfolio here consists of far more than just water, wind, power, and solar energy stocks in this context. And then I'll give you also my top investment ideas here for each green investment sector. And again, 2 p.m. London, 30th of June. Check your inbox for the webinar link if you have already registered. If not, then head over to admirals.com. And there you find the education and the webinars tab. And there you can register here, in fact, for the webinar. And here are the contact details also, but also the other social media channels I mentioned. Let me just check, by the way, here the questions I just saw. Okay, so check chart, this was something I have. Okay. Yes, that's right. Those orders can disappear in an instant. This is something which you should take into account here in this context. This is one of the reasons also. So this is why these high frequency trading guys were usually referred to as flash boys. So the orders flash in the order book and then they just disappear. This is what we refer to as flashing, respectively spoofing the order book. So suggesting that something's taking place, which is again funny because now regulatory bodies are going crazy and saying, oh wow, look at this, and we need to regulate this. I understand that. It probably makes sense. It makes definitely sense for short-term traders as us. It's more safety, but it's been there. It's been there for a long time, even years, decades before the Flash Boys then appeared on the scene. And this is something to keep in mind. Yes. So yes, there are platforms who give you an idea on how the order book looked like, but it's definitely something you have to pay for. And it's something I'd recommend. Let's put it that way. Once we trade here, CFDs, FX, and all this, so OTC products, then you don't have access to this order flow. This is something very important to know. But you can buy data. In fact, stock exchange made, by the way, lots of money with that. And you can get access to this and then use this order flow here, times and sales, tape, and whatever you get your hands on, and then use this information and trade CFDs based on that. So this is something to keep in mind if you want to still start out with a smaller account here. And I think then CFDs, based on the fact that you have micros, for example, and you have a very great scalable opportunity trading micro CFDs in this context, you can start with small amounts of money and try whether you understand what's happening there in terms of the order flow. But it's something you have to pay for and get extra from external sources. I'd recommend using Google for finding further, 'informations' on that. Is the order book a good idea for the day trader? Well, at least I'd answer this question with a clear yes. So I don't want to miss my tape. Let's put it that way. So yes, I think so. Even though it's not mandatory. So there's also other guys not using this but still being profitable. This is also something to realize. So which is then still under making sense why it's still important to look at something like that from a psychological perspective, even if you don't use it. I think understanding the order book makes definitely sense. Also, and especially probably for short-term traders, especially if you're a scalping trader. Yes. So the difference between like order book, market profile, delta, and all that you are referring to, most of the time, this is the real volume, which is traded, for example, at a stock exchange. And thus, what you have there is different from what you get at Admirals or within Admirals Supreme add-on, due to the fact that Admirals is focusing on OTC products. So still, again, and this is something which is very interesting. And so also there's some ways to use this. So it can make sense, for example, to still display, for example, tick volume in your charts. This is also something, by the way, you can use with the MT5. This is also something we can't go into too much depth here now on this, but what's important to realize in this context is you have still a positive correlation between the tick, how many ticks are traded on a certain level, and the volume which is traded there. It's not 100% accurate, but still something which could be of value for you if you decide to trade on this, in addition to your technical research you do. I'd be very, very careful with that. So it's if FX, the question is for FX, is it worth using order books given what you said? Well, I'd be really, really careful with that because, again, first of all, you have an OTC market. You don't know which market participants are displayed there. And in fact, what I know is that there's also some brokers out there playing games with fancy words like electronic communication network, and we are an ECN broker and all this. Most of the time they are not. Most of the time it's fake, in fact. Or if you have a still solid broker, then they probably have bad, let's say, or sales or service representatives and who don't really know the difference between ECN and NSTP in this concept, straight-through processing. So straight-through processing is what you get when you trade with Admirals. So you send your order to Admirals, and Admirals is sending the order to the liquidity provider, and there it gets executed then in this context. In case of the electronic communication network, some give you this access, but what you see there is not naturally what's true, what's really happening here. Like you get, if you get the real volume data displayed then, for example, from a stock exchange. And so that being said, I'd be really careful with that. If you have really access to a highly professional and institutional ECN in this context, like ICAP, for example, or a Bloomberg terminal in this context, for example, then we could certainly use this. But if you have a classic retail broker, I'd be really, really careful with that, and stick with a classic straight-through processing broker like Admirals in this context. And here's the risk disclaimer at the end. So I hope I answered all questions. Please, again, if you watch the recording on YouTube, leave a thumb up here, subscribe to the YouTube channel. Did I miss something? Post the comment in the chat box if you have any questions, and that's it from my end. So see you next Wednesday, 30th of July, on the Renewable Energy Hot Topic webinar. I really look forward to it. All the best. Happy weekend. Have a nice weekend. Enjoy yourself. Talk to you next week. See you there. Bye-bye.